What's up, everybody? In this tutorial video, we're going to be talking about falling wedges. We're going to be talking about the bullish falling wedge um, to the downside and the upside. So as you can see on this infographic, this can go both ways. You can have a bullish falling wedge to the downside and then a pop higher, as well as you can have a falling wedge rising, not to be confused with a bearish rising wedge, but you can have a bullish falling wedge um, being in an uptrend, consolidating, falling, and then popping higher. I don't make the rules, guys. I wish it was a different name for both, but this is where we're at, right? So, both falling wedges, you can either be having them in an actual falling downtrend, or you can have them in a uptrend, then a pullback. Hope that all makes sense. So let's get into it. Um, Typically, this is a charting pattern that signals a potential reversal for a downtrend. So if you're getting this and it's a downtrend and it's getting tighter and you get this pop higher, like you see here on NVTS from 2021, we have this downtrend that continuously hits the top and bottom, right? So we have this top and then we bottom here twice, come back up to the top halfway, basically hitting up here, coming back down to the bottom, and then we break out to the high side. And this is on a weekly chart as well, everybody. So this is the one pattern you can look for. And essentially with this pattern, it is a when it's falling or rising, right? Either of these two. It's when it does break out, like we see in NVTS, it is a 74% probability that it'll be true and correct, and it'll continue higher. With that 74%, I like to add my high five trading strategy. I like to also add my Williams R percentage and Williams consolidation box strategy, and then obviously other things such as anchored volume profile, price action, and uh, candlestick patterns, basically candlestick like engulfing candlesticks and different types, right? So with all of this, as you can see, we have this bullish falling wedge. And when you get this breakout, like I always say, 80 to 90% of breakouts, charting pattern breakouts, 89% come back to the scene of the crime to retest at the breakout point. 80, 90%. That means not every single time, but the majority of the time, they come back and retest. We have not gotten this yet on NVTS. We could get this on NVTS. It's just going to depend. It could stop here and continue higher. This is a small cap, so these can run a lot faster. So it could get the hype behind it, and then it will not come back to retest for a while. So you see the bullish falling wedge. Now I want to point out what a bullish falling wedge but in an uptrend would look like. So if we just take out these lines, we could see it clear. From 2022, we have this uptrend, and then we have this falling wedge pattern, as you could see with the line. And you just draw it like that, and there you go. Now, as you can see, we no longer have this bullish falling wedge. We have an uptrend bullish. I'm just going to call this one's going to be an uptrend bullish falling wedge. Or this one's going to be uptrend falling wedge. This one's going to be a downtrend falling wedge. Make it easy. Downtrend falling wedge, uptrend falling wedge. Perfect. So as you can see in here, we are uptrending. We hit a peak. We come back to retest. We go back to the peak. We consolidate sideways, getting tighter and tighter and tighter, and then pop. We get a move to the upside. And as you can see, we're not talking about bearish charts yet. These are all bullish charts. But as you can see, if we got the same thing on the rising, on the uptrend rising wedge or the downtrend rising wedge, then that's typically when it gets tight and it shoots down to the downside. So with these patterns, now that we understand how to identify them and to practice identifying them, you just got to go through a bunch of charts and just keep on putting your lines on them, keep on identifying these bullish falling wedges, bullish or these uptrend falling wedges and the downtrend falling wedges. And the more you do it, the more practice you have at it, the better you'll get at it. And that's just like anything, guys. So now that we know how to identify it, we need to understand how to trade it. Now, like I said, trade it alongside. I never just trade a charting pattern and then that's it. I also traded alongside my high five trading strategy. I also traded along, the anchor volume profile, and I used the Williams R percentage, price action, a little bit of price action, and candlestick patterns. But we're just talking about charts today and charting patterns. So very simple. To measure the move, and what a measured move is essentially if you get this breakout like you see, that's awesome. But how are you supposed to know where this stock is going to go? Yeah, you following? How do you know where it's going to go? Is it going to go way up here? Is it going to go here? Is it going to go here? Who knows? Well, that's why measured moves are so important because they tell you where it will go. So to identify a measured move, typically for any charting pattern, you are going to, what I like to do is turn on the magnet. I like to go on the price action here. It's the fifth one down in this toolbar, the measure, right? This is how I measure my price, measured moves on the price range, and then measured time frame on the date range. You're going to come in here, and you're just going to go to the bottom of the wedge up to the top of the wedge. The bottom of the wedge up to the top of the wedge. You're not going to measure this pull because it's not a flag. It's not a bull flag or anything. If it was a bull flag, then I would measure down here from the flag to the top. But for wedges, I measure from the bottom of the wedge to the top of the wedge. And then you have your 941 bars. Never look at the percentage because the percentage is going to be different the higher in price the stock goes, obviously, right? Because like from $1 to, $11, obviously 538%, but from 11 to, whatever, it's not going to be the same. So this is why you take this, you drag it to your breakout point. So right there, always give it a little bit of room too. That way it's not exactly on it or as close as possible, whatever. You drag it there and then you come up here and it's 941 bars. You draw your line and that is going to be your measured move. And with your measured move, you'll get one measured move for one charting pattern, right? And then to figure out other measured moves, what I personally do is I look for, first I look left. So looking left, we see that the peak of this wedge will probably be resistance. And that's a good little place to put your other price target. Because if you put your price target here, you have all this room to run. And in trading, they say to get it to look for a price target, look left. And what they mean by that, looking left, is that you're coming up, and then if you look left, you'll see where you'll first face resistance. Boom, right here, right? So you're coming up, and if you look left, right here is where you could put a profit target. So now we have two profit targets. Now they're pretty close together. So if you wanted to, then you could look at the anchor volume profile to see where you're going to face some, resistance or something, which honestly, it's pretty, we're launching off a volume shelf here and then it becomes very thinned out volume. So with that being said, well, if we drag it back here to all-time highs, it's still, yeah. So another area you could look for is support and resistance. So you see all this, which once was support and then broke through and then became resistance. And then, it's actually at the same spot. So look at that. It's honestly at the same spot as basically we have it here. So honestly, I'm not going to look any further and really try to figure this out. You know, if I was to go anywhere, it'd be right here. Oh, and that's just by identifying this little consolidation, this resistance, this support, and this resistance. So let's call it $8, right? So now, like I trade, is I enter my position in options and shares, and then depending on how many price targets I have, so I have 3 price targets. These ones are pretty close together, so you could just say, if you wanted to sell in 1/3 increments, you could just say, you know what, these are pretty close together. I'm just going to get rid of that one, and then we're more spread out. And so if you're selling in 1/3 increments, you sell 1/3 of your options and shares here at 8.11. You sell the second 1/3, so 2/3 of your options here at 12.26, and then you let the rest ride according to my strategy until the high five indicator goes red, goes against us, or the Williams consolidation box, which I use up here, goes against us as well. The final thing I want to talk about is your measured time frame. So with measured moves, you also have measured time frames. And with measured time frames, like I said, you take this little date range, you go from when the wedge started, so right here in 2023, to when it broke out. You take this, you copy it, paste it, drag it over, throw a vertical line on here, and 13 July 2026. The thing you have to know about the time frames, you should do them because they will tell you when this measured move will be realized. It gives you some type of time frame, guys. So on or before July 13th, 2026, $12.26 will be realized. Now, the thing you have to understand about these time frames is that typically, especially with a lot of these stocks, they will get realized a lot faster than when they're projected. Here's why. This is saying it took 588 days to form this falling wedge pattern. But typically, it takes longer for a pattern to form than when it breaks out, it takes for it to get to its profit targets. I've done this countless times. I've I've charted so many stocks. I've traded so many stocks, and I've seen it play out time and time again where we get to this profit target typically way, way, way before the time frame. You should still do the time frame because it gives you some sort of buffer. Typically, if it's over, like if this is like this would be a leap play, you could definitely play it if you really want to play the long term game. But sometimes on the daily, they're a lot shorter time frames, so you could play options around those. And also, you have your on the weekly. Sometimes they're shorter too. Like I have a lot of plays that the time frames like the beginning of 2025, and that's very, very important because that means that the move's going to happen very, very quickly. This move might take a while to play out. I still think it happens quickly, but whenever we get the time frame aligning with a quick move, and it typically happens faster than the time frame as well, then you really could have a parabolic move in a short amount of time. So it's important to do the time frames. It's very important to do the measured moves so you at least know where the heck you're going, and where you should put profit targets and take profits and when you're in a trade, or else you're just going to be sitting there and being like, oh, well, there's, resistance here, resistance here, resistance here, resistance here. So you're going to take too many profits, right? And then you have none left for the full ride. And what I mean by the full ride is 1/3, and then you hold on to the last third until the setup and the my trading strategy tells you to get out. Because that way, if you go all the way up here, you're talking about, um, you know, almost 10, almost, what is that? 7 bagger, basically. So a 7x. So yeah, this is the um, downtrend falling wedge and the uptrend falling wedge. And yeah, I know this video is a bit choppy. It's the morning, guys. Sorry. But yeah, I hope you learned a lot in this video and now understand better how to identify, chart, and how to properly plan out your trades as well. I appreciate you all and have a great day.